Thank you everybody for showing up today, especially with this weather outside. Impressive that we have so many here. How you do? Pretty relaxed.
I'm super comfortable.
Super good. I was actually going to start by telling that this is not really a networking event. It's an educational experience with a networking twist. Yet I find myself with a glass of white wine in my hand and plenty of nuts at the panel, and yeah, looking good. Really good to have this really relaxed atmosphere. Good way to start this hardcore negotiation. A couple of words about why we're here. So my name is Lars Bug and I'm from Startup Bootcamp Accelerator, pretty much all over Europe by now. We're expanding heavily, so if you haven't heard about it before, then you should have or will be. We've just landed a couple of capital deals that means that we can actually do the strongest offer for any startup out there, for any accelerator. We are adding a $1 million loan for each team after the acceleration. Rest is pretty much basic acceleration. So I'm not going to talk a lot about that. There's a small poster there with some facts. I do urge you to go in and see what Startup Bootcamp is all about. At the moment we have around 400 applications per program, almost every second month, running like that. We are expanding heavily, as I said, and we want much more applications. Right now, 2/3 are coming from Russia, US, and India. We want much more from Scandinavia. And I'm running the Startup Bootcamp in Copenhagen called Mobility XL, of course focusing on mobile, which is very, very strong in this region. So I really hope that we can also dig into to the Stockholm startup community. We do these events together with a good friend from Seattle originally, now situated in Copenhagen, Brad Ferber. Brad, you have to stand if the guy's in the... you're a tall man, so easy to see. Brad have done these term sheet battles in the US with big success, and London Business School, stuff like that.
All over.
All over.
Whoever will have me.
A couple of days back, we were in Apollo Cafe, or Apollo Theater in Helsinki. 120 people, huge success. Mark, you were there?
Great.
Cool, wasn't it?
Great.
Very good feedback, and I hope we will see some of the same today. We have gathered here today a impressive cast. We've had these events with one VC showing up and one CEO to defend himself. It's fun, but the CEO get creamed. So we don't want to let that happen. So what we did is, and we do have a CEO here, Martin from Mimoto, who helped us in the Mimoto, sorry, who helped us on the cast here, and to help kind of make this side more heavy, we have Martin von Haller from Bird & Bird, being the loyal lawyer, and then on the other side of the table we have Christian from Sunstone, and then we have Martin from Cleando. These guys are not kind of like the VC guys you normally see out there with old funds who are just hanging out to get wine and see you guys work like hell. These guys, Cleando just closed a new fund of 135 million, and Sunstone's fund is 1.5 year old.
Yeah. Euro.
Yeah, of course.
Yes.
Of course.
Thank
you. So these guys are the real thing. They have money to spend, and this is good practice for them, I think. So please help me welcome the cast for this.
Thank you, Lars. So I just want to say a couple words about the term sheet battle. It is a program that I created back in 1995 when I was a securities lawyer in Seattle, looking for clients really, and it worked pretty well. And what was interesting about it is it started out being a CLE, a continuing legal education program for lawyers, but it turns out that the demand for the program was overwhelming within the entrepreneurial community. And what we've found as we've put these programs on throughout Europe is that by far the people who like to come to these events are usually entrepreneurs, sometimes unfunded entrepreneurs. We do tend to get a few business angels, not a whole lot of VCs. So before we get going, I guess if you could raise your hand if you are currently an entrepreneur. Raise your hand if you'd be interested in talking to a couple of VCs with dry powder. Raise your hand if you currently have a lawyer that you're already working with. Okay.
Good deal, Phil.
There you go. I think one of the things that hopefully you'll learn tonight is that when you do finally land a term sheet, it's real business. There's a lot of talent and time and effort that goes into this, as you'll see tonight. So let's go through. We've already introduced the cast and characters. Our hypothetical, and we did make these materials available on our website. I apologize, they should have gone out a little bit earlier, but hopefully you've had a chance to take a look at them. If not, you can check them out right now online, or afterwards you can also download them. But the idea is we have a hot startup that's got some traction in the community. Hypothetical is that this hot startup went through the Startup Bootcamp Accelerator Program. They presented, as all the startups who come through these accelerators do, at Demo Day. Put on a good presentation, caught the attention of some of the investors, including Ravenous Ventures in the crowd. Ravenous invited the entrepreneurs in. They've had some meetings. They've done some due diligence. And now Rave Ventures, is how we'll refer to them, has gone through the process of getting approval from the investment committee, hired a lawyer to draft a term sheet, and presented a term sheet. And that term sheet has been reviewed by the Entrepreneurs Council. But this is really the first meeting where they're coming together face to face to talk about this term sheet. Now, one of the things that some of the feedback I get from other programs is that it's hard to get an MBA in venture finance in 2 hours. But what we've done is we've tried to organize the program so that there's really a first half and a second half. And for purposes of the first half, we're going to talk about what's commonly known as economic issues, and then there's control issues. You could call them other things if you want, but fundamentally, we've identified 5 or 6 of the key economic issues. We're going to then take a quick break, 5 or 10 minutes, and then we'll come back in the second half and we'll talk about the so-called control issues. Now, one of the other things, the feedback I got, even from Helsinki, we're going to do a Survey Monkey, is that it's helpful if we sort of do a timeout at the beginning of each one of these rounds and just describe exactly what we're talking about, because although everyone up on stage understands the jargon, it's not necessarily the case that everyone in the audience would understand the jargon. So we're going to do that. Also, keep in mind, everybody up here who's doing this is an actor. And we've encouraged them to improvise and get into the role. So this is not necessarily them as who they are. This is just them as who they want to be. It's like being an avatar, right? And put on your evil hat. You can do whatever you want. It's up to them. We'll see what they come up with. In terms of how we get this going, usually I'll turn it over to the cast at this point, and I'll start with, I guess, Martin. And Martin, that was the last thing. I mean, how many Martins does it take to do a term sheet battle? I think in our case it takes 3. But there you go. Let's go.
I just wanted to start by saying that we actually had a meeting discussing how we wanted to do that, as we always wanted to do. And we could decide how to divide our roles in any way we wanted to. But we decided here that we're not going to go for a good cop, bad cop. We're going to try to be a little bit good, a little bit bad, and try to improvise our way through. And in this situation, because Martin here is actually quite experienced, or somewhat experienced, he's going to be leading the discussions and I'm going to chip in. It could be the other way around, that I was going to start by insulting everybody and you would try to make friends afterwards, but this is the way...
No, I do that, yeah. Excellent. Yeah, so, and that is actually how I would play this out in reality as well. I want to take the role of driving the discussion and the conversation with the VC. Cool. Excellent. So thank you very much for making it to this meeting on a Friday night with this weather. So we're very, very happy to read through your term sheet. Me and Martin have discussed it in detail. We're super happy about you wanting to invest in our company. And with the huge success we have in the market, I think that we can do very well in working on this together.
Cool. Then we should sign it.
Yeah. So we had a couple of minor points to discuss before we bring out the pen.
Maybe I should give a little background before the discussion, because we like your company, and especially we like the team. It's a great team, and we think with our support, we can really turn this into a success together. But of course, this has not been an easy decision for us. We had a long discussion in our partnership, and the attitude in the partnership was so that little bit back and forth. But we decided on the right terms, right conditions, and if we could make a term sheet that would work, we would like to do this investment.
I think we should mention that. We also have discussions because, as Martin said, this is actually a company with a lot of traction and a lot of people interested in it. So not that we are going to another meeting after this, especially not if we are signing anything, because then we're not allowed to. But we want to talk to you. We want to have this to proceed. But we are in a situation where we are a little bit. How should I say, lucky, because there is a lot of interest in the company.
But on a Friday night like this, it would be lovely to, if we could cancel the other meeting we have this evening.
Yeah. Especially the one tomorrow.
Yeah.
Cool. But then we should sign.
Let's get going.
Yeah. So, as you know, we proposed a valuation of 3 million euros pre-money, and we are prepared to take a dilution of 20%. And you actually offered to double the investment we asked for, from 750,000 euros to 1.5 million euros. And we are super happy about that. That is really excellent. To do it in two different tranches is a no-go for us. We would love to, if you want to increase the investment on the dilution we asked for, that would be great. And anywhere between 750,000 and 1.5 million would be doable for us under that dilution.
And I think you understand that. We are in a situation where our budgets and so on, we feel pretty comfortable with that we can do with 750,000 euros. Obviously, we always want to take in as much as we can, but we're also in a situation where we will probably want to achieve some results and be able to take that remaining funds in at a higher valuation. So it's
yeah. And we love the milestones that you set up for the second tranche as well. And when we reach those milestones, we certainly feel that we are prepared to take on a second round, and then we can do that together and decide for a new valuation at that time.
Okay, I think on our side, one of the things that was discussed in the team was that we felt that the initial stake was a little bit small, and that this was a good way. You guys got the money that you asked for at the valuation you got for, but this would also give us a way to reach the ownership ownership stake that we were targeting, because we think we're going to spend a lot of time on you guys. There's some things that you guys don't have in your team and that you're going to need to learn, and we think that's going to be very consuming for Martin to help you guys out with that, right? And so this was a way for us to get all the team members on board with, a smaller stake initially, but then getting to where we want to go, right?
And we want to avoid what we see in so many cases. The entrepreneurs take in not enough money. You can talk to any of our portfolio companies and ask them whether they should have taken in more money when they could at an early stage. I'm sure that most of them will say yes. And by doing it this way, you get the valuation you asked for. You get more money than you asked for. And you will not, if you deliver on the milestones, you will not have to spend all the management time needed for doing another financing round.
Yeah, and I can really appreciate that you take that position that with more money we can achieve a higher goal. But what you see from time to time is when VCs force or tranche structure like this, the team can easily get into the mindset that 750,000 euros, which is relevant now, is also going to be relevant for the company a year from now. And that is a super dangerous mindset, because a year from now, $750,000 euros is going to be change money for us, and that's not the mindset we want to set out with.
And I guess regardless of whether how getting that much cash on board from the beginning influenced the mindset of the management, the big problem with the incentive is, of course, that already from the beginning you have a bigger stake in the company than the founders. Not the founders, but all the founders together, and one of the founders is even smaller. So you must realize that this will really make it will have a quite dramatic impact on how you see the company going in the future. We obviously have to go through more rounds, and even after the next round, the amount left for the management, for the founders, would be not negligible, but at a percentage that probably is going to de-incentivize you in some way.
The problem here is that we feel that you guys need to hire a lot of senior management, and so we need like a side. You already have spent 5% warrants, right? And you're going to need a sizable warrant pool. So from our perspective, the team is not complete, and we kind of have to value on the basis that you need to fill out the team to actually complete these milestones and then build the business, right? And so it's true that the current founders will have a smaller stake, but the entire team that can actually succeed with this company will, also dip into the warrant pool, right?
We see very often that European companies, they take in too little powder to be able to execute. If your company and if your space is so interesting that you and we believe, you will need execution power, because you will get competition, and you will get competition from large players abroad who will have dry powder enough to compete. And if you then are going to do another fundraising that takes half a year of the management time, they will be far ahead of you before you even get started.
We need you to think big. Really big.
But I think we're very much willing to do that.
And that is exactly why we feel that to have the same valuation a year from now or 6 months from now that we have now is not thinking big. That's thinking very, very small.
Of course, for us it has been an evaluation, because of course it's a question about how much ownership should we have for how much money, and that's what it's all about. It is a balancing thing, And we are trying to do our best to balance this out, because we want motivated founders running the company, and we want you to have an ownership stakes that's substantial going forward. But still, we have to be able to defend what we are doing. We are a venture capital firm. We are looking for a 10x return in our investments.
Yeah.
That's why we are willing to take the kind of risks that we do. And yeah.
And the problem here was that you guys asked for what we thought was a too high valuation for the first tranche, right? So if it had just been the first tranche, we would have offered a lower valuation. But then by slotting in the additional money, we actually get to the stake we want for the full amount, right? And that's how we came up with it. So we could have had two different valuations, but it would have been a smaller initial and then a larger secondary. It still would make a difference once all the money came in, right?
So we can argue back and forth on this. And what I think that we are prepared to do is to make an agreement where we give you a slightly higher amount. We can provide a slightly higher amount of dilution if we cut down the option pool to half. And I don't know if we can offer. Yeah.
We should take our time, right?
Yeah.
We should. We have to.
That's a good deal. We should take it.
Are we willing to accept that that is 1.5 from the beginning at the present valuation just by reducing the pool?
No,
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 exactly.
but we need to suggest another valuation that we can be prepared to raise the amount of capital slightly if we can lower the option pool, I think.
Okay. Now you can listen. Okay. And I think there are a couple options here. And either we could say, well, we do this deal just with the first closing, or we could find some kind of a compromise that secures that we are nowhere near that in the first round of a series, in the Series A round, that the founders are actually under having an ownership stake that is smaller than the investors. So if we can find some kind of how did you describe it?
Yeah, so the option pool of 20% is something that I would certainly be willing to offer in the long run to acquire key employees. But we're working together on this. You are going to participate, hopefully, in later rounds as well. And I think that we should each take on some dilution for the warranties and for the option pool ahead. So let's bring the option pool down to 10% on closing, no matter what we end up at the valuation.
And there are these two pools that are the ones that are granted. We are of course willing to say the full dilution with respect to them is on our point, is on our side, but the pool that we're going to grant going forward, we have to suffer equal dilution with respect to them.
Yeah. So should we come up with a suggested valuation on the spot, or should we take this one to think about?
I mean, if you can meet us on this, then I think we should figure out the numbers once we get the time for that.
So what you are saying is that you accept the valuation and the two tranches based on that we lower the option pool?
No. I'm not saying that. I'm saying that if we can work with both the option pool and higher valuation, then perhaps we can find a common ground there.
And one closing.
And one closing.
One closing is a no-go.
Yeah, I don't.
You're not proven enough for that amount.
Yeah. Then we need to negotiate different valuations for the closings.
All right.
Okay. That could be something that we could discuss. But what I'm very hesitant to give up is the option pool, because what you guys really need, you need to recruit world-class management and build a world-class management team. And taking away the tool, the option pool, that you need to get those kind of people on board that we really think you should have, I don't think that will benefit you, and it will not benefit us.
I think I'm very happy that you think that we will be able to acquire key employees to world class, but I also feel that you're slightly contradicting yourself, because you said before that you really believe in the existing team. So
For the parts that they do well.
No, but let's be sure. I mean, if we are talking about an option pool of either it's 10 or 20%, if it's equal dilution afterwards, then I think we will. It's something that we will be able to. We will have a say on how it's used. It's not something that you can force the actual program and distribution. Is not something that you can force on the company, and vice versa.
Yeah. So we can commit to distribute 20% in options if they dilute us equally.
Exactly.
So at this point, we're putting in the 20% pool, and you're asking for 10 new or 10 in total?
No, we're asking total. The difference between what's been granted now and what is going to be the combined amount, that we can accept. We could probably also accept that it was higher, as long as the dilution coming from that is shared equally by all shareholders.
Right, so that maybe we think about that, and then we put together kind of a basket, and we look at it a little bit later. So we understand what you guys are looking for.
Just one more thing. It's important that with respect to any second closing, if that's the case, it's not going to be an option. If these criteria are met, then you have to invest.
We have in this term sheet we have been very kind to you, because normally we would
this
actually.
This was the Swedish team that wanted to do this.
Normally we would have this option of putting in more money as an option for us, a put option for us. But as it's written here, it says the second closing shall occur. So it's really a call option from the company if the milestones are met.
But just as I would agree to you there, but just as you cannot, for instance, block that call by saying at the board that you're not going to call it. It's got to be a firm commitment that it will take place unless anything else.
But we would probably want the team to renew the reps and the warranties and stuff like that.
Absolutely, that's
so you want.
Why do you want to be on the board then?
Well, it's just to be nasty, right?
Okay. but I think we can discuss that when we get to the reps and warranties.
Okay.
Okay,
We gave away too much there, didn't we?
I don't think we can.
We're too soft. It's Friday evening.
So one of the things that may be obvious to some but less obvious to others is that when you're talking about the stock option pool, the question becomes how many options should be included in that pool and at whose expense. So the idea is, the proposal was, okay, we're going to put this huge number of options into the pool, and we're going to drive the pre-money value down by that amount. Now, it is customary, in my experience, that the VCs want to have enough options to be able to attract, retain, and motivate. But what's unclear, I think, is how much is enough. And so that's what that's all about. Just in the interest of moving...
Is that clear? Do people get the difference?
No, so is it basically like a part of the company you just put to the side so that you can use that as part of like some kind of salary, another attraction for other people's that the VCs want to employ for the team?
And we want them to put the shares aside before we come in, so we get our stake, and they, without having to pay a share into that allotment, right?
So we want to invest a certain amount of euros and get a certain number of percentage in the company, including the options.
Or you could put it in another way. Normally, if you have a company with some shareholders, whenever new shares are issued, then everybody will be diluted equal or in proportion to their shareholders. What they're proposing is, no, we shouldn't be diluted. The shares should be taken out of your stake.
Yeah. So when the key employees come in, only the founders pay for the employees. The VCs get to keep their shares. It's a very evil scheme.
You can comment on that, but I think a kind of fair way to do it would be, what we've done here is really unfair because we say they should put in enough that it's 20% after we put in all our money. And maybe a more balanced way would be to say that they should put in enough that it was 20% before we put in our money. And then we put in our money and we top it up to 20, because then we pay for the part that we're in. Does that make, that would be a balanced,
or we could say,
right?
This is really about valuation. It's the only thing that matters there is valuation of the company.
But in this case, it's also about how much you actually own of the company, because of the prior financing, we are in a stage where you are already at this point have more than founders, and that's kind of problematic, I guess.
It's like 2.8.
And also just, if you look at the milestones, one of the milestones is that they achieve profitability. And a lot of VCs, are more interested in growth than profitability. So you might just address that as, A, how often do you see tranche proposals? And B, companies, they might change their mind, right, about what it is that they're trying to do. So, to set it in stone now, I don't know. I mean, what are your thoughts?
I can comment on that. We don't like milestones because it always creates problems. It makes unnecessary noise, and we use it very seldom in our term sheets.
And from our side, what we were addressing is, one of the first things is, of course, the share price for the different rounds. You get an option to invest, or you get a right to invest at the price, at the valuation of the company, one time in the future when it's supposed to be much more worth, because among other things, reaching the milestones. And that might not be fair, because we could probably raise those money from somewhere else at a higher valuation. The other thing is that in a lot of situations I've seen that you tell the entrepreneur that we are going to invest a certain amount, and the entrepreneur is very happy about that, but then it turns out that you're not going to invest that because you have an option to do it, and you're not really you're not forced to do it. It's just a free option. You can actually give it more or less for free, saying that if I want to, if I feel like, I'm going to invest some more money in the company at a later stage. And it's, from our point of view, very important at this point to make sure that there is a very firm commitment that this money will actually be put into the company if it turns out that the milestones are met.
All right, so we're going to move on to the next one. Now, the thing about this, you might say, geez, if you spend 30 minutes on this one issue, this is going to be a long night. This is actually, go ahead. This is one of the biggest issues for at least most founders, because it sets in place the initial valuation. There's a lot of other things that we can talk about. And next up, we're going to talk about liquidation preference. Now, liquidation preference, who here, raise your hand if you know what that is. Raise your hand if you don't. Okay, interesting. So what a liquidation preference means is that one class of shares has a senior right over liquidation proceeds. So let's just give you an example. Assume that the VCs invest $3 million, and assume that the company, and assume that they got whatever, 1/3 for that. Assume the company then sells for $3 million. Does the VC get $1 million and the founders get $2 million, or does the VC get all 3? A liquidation preference of 1x, or even a 2x in this case, or a 3x or a 10x, doesn't really matter. If the company sells for 3x or for $3 million, they get the $3 million. If you don't have a liquidation preference, if it's common stock, then the VCs essentially would lose $2 million and the founders make $2 million. So that's what this fighting is all about. Okay.
Regarding liquidation preference, we had lots and lots of discussions back home about this, because my co-founders have a very hard time to understand why you would get your money back even if the company does not do well. They ask, but aren't you venture capitalists? You're not. It's not a loan. You should take some risk as well. And I tried to explain to them that yes, but they can perhaps succeed in putting together a very successful fund if they ask for these kind of preferences. So after a very long discussion, we I got them to agree to, and on a very slim margin, that if we lower the multiple to 1 time, and instead, almost as a bank, we can grant that, okay, you can act as a bank, we can give you an interest instead of 8% or something like that. And we make the liquidation preference non-participating preference instead of what is here, then we, I think I should be able to go back to my team and convince them that this can be kept in the agreement.
I think we could work with a hurdle rate, maybe instead of the 2x, maybe in the 10-ish percentage terms, but we need the participating preferred. And that's, the team, that's what it took to get it through the team. Do you agree, Martin?
I agree to that. We could, because I can see your point that 2 times is maybe. I understand your argument on that one, but you should remember that we are handling other people's money, and other people's money need to be treated well, and our contribution into the company is this funding, and for us to make sure that if there are proceeds left, and that is the risk we are taking, because in very many cases of us investing venture capital, we don't get anything back. But we are trying to secure so much that our investors get a fair share of those money back. So a liquidation preference 1x with a hurdle rate 10-12%, and participating, I think that would be fair.
That could work.
Yeah.
Well, it's I think it's a little bit unfair to bring fairness into. The situation is obviously you're handling other people's money, but we acknowledge that if you look at a claim on the assets of the company between founders and investors, it's okay that you have some preferential right to get that. But it should be used for the situations where the company is in a situation where obviously there is not enough money to give you back what you invested. It shouldn't be used for some kind of a secured investment on top of that. If you're handling other people's money, you should try to secure that you at least get back what you invested. That should be it. So we, as another way of saying that what we were suggesting, which we think is fair, even though you can discuss whether it's fair that you shouldn't take the same risk as we are taking, is to say, well, if we are in a situation where there is not enough money in a liquidation of the company to pay out what you actually invested with some interest, then we acknowledge that you will actually get that amount of money that you invested plus some interest before anybody else gets something. But you cannot get it twice, in the sense that when that amount has actually been distributed to you, then you cannot get any other amount on top of that before you would be entitled to that if we shared according to shareholding.
Yeah, so because it can be if we end up there, the company has done not so well that we expected. Then when in an exit situation, as the lower the valuation is at that point, the higher our misalignment will be.
Exactly.
And that can be very, very unfortunate in a situation. It can create a problem where none of us get nothing because we cannot agree if we should make them exit or not.
We don't want to be in a situation where you can actually see, well, it makes sense for us to shut down the company now because we actually get our money, a better return than we would actually get in the near future from continuing working with the company.
I'm kind of confused. If you think that's a likely scenario, maybe, this is not...
Yeah, I was thinking the same. If we think that's a likely scenario, we don't need a preference at all.
No, so I think if you guys succeed, which you want to, right? Then the small amount that we take out first, is not that much really. I mean, if you sell for 200 million euros, like you said, we take our 3 home or 1.5 home first, and then we share pro rata after that. I mean,
But I think- I
it
think-
moves 10
Yeah,
percent.
I think
You should- you
I
should
think
just-
it's good that you think big. You said before you want to think big, even if your thoughts were small at the time. But you cannot discuss this clause in the context of when the clause doesn't matter. You have to discuss it in the context of the situation when it does matter.
Otherwise, I have to go home.
Yeah.
But I think you should appreciate that investing into your firm is a high risk investment. And that high risk investment has a price. Of course, the price is paid in two ways. One is that we see an upside in the company. There is a potential reward. But there is also a downside. And the downside is what we are really talking about here. And you should appreciate that there is a premium for this kind of money. And that's what we are describing here. And we are actually discussing now giving away 1x. And the premium is that, yes, we get our money back, and then we participate with a hurdle rate, and then we participate. So that is in a way the price for the venture capital that you are paying.
But I think you, with all respect, confusing things a little bit, because we surely appreciate that you're investing to get an upside, and that's what you get by getting a percentage of the proceeds.
So maybe
But the liquidation preferences, I want to know, do you get that in order to top up your potential upside, or is it because you want to protect yourself if there's not enough money to pay back your investment?
Well, so-
It's both. It's both.
So I think maybe
Okay,
so just comment. So maybe we protect the downside mostly with this, and maybe we could do a compromise would be that the participating falls away above a certain exit.
Yes, I like that.
All right, so
Yeah.
it's a certain level of exit value, the participation.
You are too
drops
easy
off.
tonight.
Okay, so we're gonna, in the interest of moving forward, one thing that was talked about here was this so-called hurdle rate, cumulative dividends. Does anyone know what we're talking about when we raise your hand if you know what a cumulative dividend is? Nothing. Who here has heard of Albert Einstein said one of the great inventions was compound interest? Yeah, that's what a cumulative dividend is, and essentially it's a way to tack on a return. And so, over a period of time, even if there's a 1x liquidation, if you attach a cumulative dividend, it could grow to 2, 3, 4, whatever it is. So that's what that's about. We're going to move on to another subject that I have found is something that a lot of founders are quite interested in, which is reverse vesting on founder stock. The idea behind this is, okay, you own the stock outright now, and now do you have to earn it again?
But okay, so just this, from my perspective, I think we don't see 2x in technology. So 2x is something that I hear they use in life science. We have a life science division as well. So we hear about that. I think a hurdle rate is much more common. I think participating preferred, which is also called a double dip, where we take out our money and then we share pro rata, is not commonly used in Europe, but it does appear. What you really want to move towards is something where there's a 1x liquidation preference, then there's a hurdle rate, then there's a catch-up interval, right? So the founders catch up to the preference of the investors, including the hurdle, and then you share pro rata, right?
And you are actually right, because we use liquidation preference as a downside protection.
Yeah.
We want to make sure that if there is still money there, we get money back. We very often use a hurdle rate or an interest rate, compounded. But that is, we consider that being fair. It's
The reason why we use a hurdle rate is because we often have a hurdle rate. So when we draw down money from our investors, they put a hurdle rate on it, and then we try to match that hurdle rate with the one we we pass on downstream in the kind of flow, right?
And I think you, from a practical point of view, I'm not sure that it's like this all the time, but as a downside protection, when is it really relevant? Because once the company hasn't got any money, there's probably a lot of creditors and other people before, so it wouldn't matter a lot. It's really most a question of how you divide the spoils. In the other end, if you're getting it as part of an increased upside, that's where it will matter. Have you ever experienced actually that you took advantage of liquidation preferences in
Yes.
Okay.
Yeah, in the cases where we get what we call a mediocre exit, 1x, 2x, 3x maybe, then the liquidation preference will mean something. If we invest in another Spotify, it doesn't mean anything.
But the trick is, sorry, just last comment, I think the liquidation preference, it sets the stage for a new negotiation between the investors and the management team at the point of a mediocre exit. That's my experience. So you never really get to use it like it was written. You use it in a kind of adapted form when you actually do the exit.
But with the investors having the leverage.
Exactly.
Yeah, that's right.
So if you're raising money into your company, one situation you will often find yourself in is that you need to explain all of these rather abstract companies internally to your early employees who are often also shareholders. So one thing that I found very useful in this case is to just put them in a chart where you have on the x-axis the exit valuation, and then on the y-axis you can draw different lines representing the different stakeholders, and then you see very clearly when these different effects kick in. It becomes much more easier to grasp than having to understand the chart.
That's true.
Yeah.
And you can also bring in the investors for kind of a town hall meeting.
You can fall into the trap of believing the VC if they say that, yeah, but a participating right is standard. We would never accept anything else, because they do accept non-participating as well. And if that's important for you, then you shouldn't accept anything else, because you can achieve that.
Yeah, no, like anything else, these terms are market-driven. So if it's a frothy market, then there's more money chasing fewer deals, and the entrepreneur gets better deals. And if it's a weak market and it's hard to raise money, then you see the VCs popping in with different stuff. And right now, actually, the market isn't quite as healthy as it was even 12 months ago. So my data, the research I've done, at least in the United States, is some of these things, participating preferred, liquidation preferences, are getting a little bit nastier right now than they were, say, 12 months ago. One of the things that you pointed out, Christian, which was how the VC fund is set up. That's important, and as long as we're on this subject, maybe you could take a minute or two and just kind of talk about how you have investors too, and you have to give money back to your investors. So
Yeah, so basically we go out and we raise money for like 10-year allocations, and they commit the money, but we don't take the money from them from day one. We can kind of draw it down, we call it. And the day we draw it down, there's a hurdle rate that accumulates on that amount as well. So we draw down something for investment in Memoto, right? And then the hurdle rate kind of starts accumulating that we have to pass back to our investors, and we try to match that with the hurdle rate to you guys. And then, we put together a fund, of course, of like 20 investments, and some go bad, some go good. And as soon as we make exits, the money goes back to the LPs. And typically, for a venture fund to be really successful, we have to return 3 times the amount of money that they committed originally. In here, there's a couple of things that are important. One is that we make money on a management fee, which is a percentage of the fund size that's paid to us through the years, simplistic terms. And the other thing that is important to note is that we cannot reinvest money. So if we invest some money in Memoto, and you for instance, you sell one product, but not all your product. You exit, do a partial exit. If you return some money to us, we cannot reinvest it normally. Sometimes you can, but typically you cannot. So we just have one shot with the money we have.
What about the carry?
So the carry is typically it's 20% split after we have returned the committed capital plus the hurdle, And for us, like for you guys, it's sometimes we have catch up, and sometimes we don't. So sometimes we take 20. Yeah, it's the same as the liquidation preference. Our investors have a liquidation preference as well.
Quick question, yes.
What is LP?
The LP is the limited partner, so that's the pension fund or
That's
whoever
our
it is.
investors.
Yeah, that's our investors. And the fund, the venture fund partner is called the GP, and the investor in the fund is called the LP.
Okay, so we're going to keep going. We're 53 minutes into the program, so let's try to move through this as fast as we can. Reverse vesting on founder stock. I'll give it to you, Martin. DH.
This is a tricky question for us. As a point of departure, we have a hard time seeing why the shares that we already own in the company should at any time be passed to you. We've invested, we've done a lot of hard work, and we own those shares. You're investing in new shares, and it's difficult for us to see why it's at all necessary to, at any point, actually be forced to sell it back. However, not to protect you, but to have some kind of mechanism within the founders. We think that it's okay to discuss some kind of reverse vesting for founders, but it should be something that is done within founders, so that if somebody is forced to sell their shares because they're leaving the company, then it should be the other founders who have a first right of refusal for the shares.
For us, it's the situation is so that we are investing in the founders' team. That is really the substance of this company. It is the founders.
So you need an option to...
And if you run away, we feel cheated. Because that is really the basis of this investment. That is that you guys, you stick to what you are going to do, you stay there, and if you leave, yeah, then we come and take you.
And we lose as well as the other founders. So we need to be kind of kept whole in our loss as well, right? And then if you guys really want to do this and you're committed to do it, we don't think this should be an issue, right?
And saying that, okay, if one of the founders leave, then the two other founders should have this. Okay, we lost 1/3 of the team. What kind of compensation is that for us?
But you said that both founders and investors lose out, so that means that you in principle would accept general pro rata first right of refusal when somebody sells?
We could of course discuss that. But I mean, if this is really a big issue for you, we don't like it. Because you have to make up your mind. If you're in here for these years that it will take to build this company.
Yes, and what you're talking about now is what the vesting clause is for, and in that regard, I agree. But as for the voting rights, as I think I will talk about
we're talking about in what situations you as founders would be forced to sell your shares if you leave the company. And I think we have some understanding of the purpose, and even though we are going to feel as much pain as the remaining founders as you are, we can understand that there is some kind of need for that to protect everybody. So we think that this is something that we're willing to accept to a certain level if it's at least pro rata. And one more thing, I think it's also, if you look at it not from the company's point of view, but if you look at it from the founder's point of view as individuals, as human beings, they can leave the company for different reasons. And I think it would be fair if they're not leaving it because the grass is greener somewhere else, or they just want to go sunbathing or something, but because they're sick, or you actually decide that you don't feel that they're necessary anymore, then there should be other clauses.
I think we could discuss that. I mean, if you die, at least if you die at work, there should be some clauses that maybe treat you lighter. But yes. I agree to that. It's there are different scenarios that could be handled differently.
So we could have a good leaver scenario and a bad leaver scenario.
And a good leaver is somebody who's died.
If you die at the office, you're a good leaver.
Yeah.
Okay, so we're gonna, do you guys want to just talk about what sort of standard practice here in the Nordic region, and then we're gonna keep moving forward?
I can comment on what we're talking about, that me as a founder should actually be happy that my co-founders are forced to stay in the company, and I think that it's not a bad thing to have a vesting clause in agreement, because it is fair that if one of my co-founders leave the company, that they should sell their shares back to the rest of the shareholders in
To
some
the company.
kind. Yeah, and so it is very good, and I think that it should be in the shareholder agreement. It's not something that you should negotiate away, but make sure the numbers make sense.
Would you have a penalized valuation at that point?
Yeah, so typically it would be, in a bad lever it would be at par value, and in a good lever it would be at some kind of market-driven value, right? So just from a VC, so I've both been a founder and as a VC, right? And I think founders very often they understand or they don't appreciate how damaging it is for themselves when one of their partners leave. So they often just look at us as the guys trying to take their shares. And then when one of their partners leave later, then they get really pissed, right? And so this is a good structure, I agree. What you should negotiate on is the good lever, bad lever. Sometimes there's a no-cost lever as well, which is a totally third category. And then you should negotiate on not 100% being in the pot, right? So you can go in and say we want to have a third vested upon closing because we already built this amount of value, or half or whatever, right? And then work with the VCs to find that level where the VCs and you feel comfortable that you're given something for what you bring to the table today.
The point being that this kind of clause should serve to incentivize people to stay on and make sure that this is happening, not to take away any hard-earned value for them if it's not their fault that they're leaving, but it should make it painful to the extent that it incentivizes them to actually stay on.
Yeah, that's the purpose.
Yeah.
And just one last comment. The bad thing is that this is going to be renewed later, right? Because then you do the first round, and you raise the money, and 2 years later you raise the second round, and now you've vested half of this, right? And the new investor comes in and says, "Ooh, we need to look at the vesting," right? And sometimes they force you to put part of what you vested back in the pot. I mean, it depends on how far you've come.
If a co-founder leaves, is it typically goes that into the sort of founder pot, or is it divided equally among all the shareholders?
That's what we discussed here. It varies. Sometimes the investors takes it because they have
You should
betted on the team. But normally, I would say the normal thing is that it's divided between all shareholders.
You should push for having it all go to the founders. You just said that you make your investment. If we distribute shares within the founders, that's our right.
We wouldn't accept that.
No.
What we would accept is that the company buys it.
So you push for it, maybe not expect to make it, but try it and see what happens.
We're just succeeding with that in one of the terms that we're closing on Tuesday. Just between the founders.
Just behind you.
There is another option. What we've done here is that we've simply put it back into the stock option pool.
Yeah, that's the same as the company reacquiring it, right?
Right,
And
but it's not. It doesn't go to the founders. Doesn't go to the other shareholders. Doesn't go to investors.
I
It's just to hire more people, which kind of makes sense because ultimately you're going to need to replace the people. Who leave.
Yeah, exactly. So then if the company reacquires it, you can actually make options to buy that stock and issue those options, right?
So what terms do you buy back?
So typically if it's a bad lever, it's at par value.
So basically nothing. It's just 1 krona per share.
Yeah. And if it's a no-cost lever, it could be at the valuation of the investment. And if it's a good lever, it could be at a market valuation set
Or
somehow,
50% of market valuation
Could
or
be
something
anything.
like that. But
And then,
considerably more than a bad lever.
And then suddenly all founders want to leave.
So So not
but then they
serial
wouldn't be
founders.
completers.
Hey, so we're gonna move on to the next one, but before we do, there is this concept. It's called a single trigger versus a double trigger, and in the feedback I got from Helsinki, people thought I should have explained what that was. In a nutshell, if there's an M&A acquisition, the question is, does that accelerate all of the vesting, 100% of the vesting, or is there a second trigger that requires you to stay on after the M&A transaction?
Does it make sense?
Yeah.
I don't know what M&A is.
Oh, I'm sorry. Mergers and acquisitions.
Oh.
Company gets acquired. Does that mean, okay, everybody, rings the bell and all the shares are vested? Or is there still a requirement sometime after the acquisition to stick around and do post-merger integration? I'm not going to get into it right now. Okay, quick question.
We should explain it a little bit.
Quick question around that, like in practice, like does it ever matter what it says in the shareholder agreement? Won't all that be renegotiated as part of the acquisition anyway?
This
I
matters
think
a lot.
it matters a
This is
lot.
very important. Right? So typically in the old days there was full acceleration on exit, and what that meant was that the team was basically free to go because they had all their economic rights from the time they sold, right? And then the acquirer had to motivate them to stay, which was really hard. And so the price became what they bought at, plus this incentive program they had to put in. And so what we're all trying to do now is to find a middle way where management is incentivized to stay. And so the double trigger would typically be, in our case, that you get 50% acceleration on the exit, and then you get the rest you vest after the exit on a normal pace, unless you're fired, because that's what then sometimes happens. So the second trigger is termination within 12 months of the transaction, at which point you get full acceleration.
Without cause. And the reason for that is a lot of times there's redundancy, right? So if you're the CFO of a company and you're acquired, pretty high likelihood you're going to get fired.
Yeah, exactly.
Engineers probably not, but there's different, yeah. So
But then you should vest. Then you
Yeah,
should get
right,
everything
yeah.
you get, right? So the case where you leave yourself, you don't get full vesting, and if you're fired for cause, you don't get it either.
one last question. Yeah.
Doesn't these terms kind of depend a lot on what kind of buyer you have? I mean, in terms of what kind of integration you have to do after the merger?
It might be renegotiated, yes.
But the point is that if all shares are vested at an acquisition, then the leverage to extract more value of the acquisition or the value of the acquisition is with the founders or the CEO. If they were forced to stay on forever and their shares would not be vested at that, the leverage would be on the other side. And it's actually finding that middle way, and I think that's more or less what you described.
And the importance here is that it's for all of us, if you're repeat entrepreneurs, you want the exit market to be healthy, right? So we need some of these acquirers to have a successful experience in buying a company and integrating it. And if the management team can walk out on the first day after they start, that's not going to be successful, right? And then people stop buying these companies, right?
All right, we're moving on to another one that's near and dear to founders' hearts, which is representations and warranties. So, and before we get into that, what that means really is standing behind, in the purchase agreement, you say, we hereby represent and warrant that these facts are true, except as disclosed on the disclosure schedule. So the question is, what happens if you're wrong? Who has to pay the cost? And is it the company or is it individuals?
And reps and warranties means that you promise. We promise that this is the way it is, and if not, we will pay. Right?
Right.
Just
That's right.
English.
Yeah, that's right.
So in regards to this clause, I guess it would be fully acceptable if we actually got to see your standard representations and warranties, but it's actually not in here.
That is correct. What we are saying here is that we call them standard reps and warranties, and what we really want you to accept is that you warrant that the books are in good shape. You own what you say you own. You have the licenses you say you have, and that really the company is in a kind of shape that we can expect it to be.
And I think that's quite normal, and we would obviously accept that. It's important for us to make that distinction that it's these very normal and usual and reasonable things, and there's nothing put in that is with respect to the future of the company, future revenues, future development and things like that, that we are not masters of.
Yeah, and we only warrant what is happening up until now. We don't warrant what's happening in the future.
That's fair enough.
I think that's fair enough.
That's fair.
And just one more thing, I mean, is obviously you're asking us to take on these personally.
Yes,
We will be personally liable for them.
Absolutely.
My lawyer as well, because he's pointing to himself.
Because I'm one of the early investors. I would have wanted. Okay. But there is important that the liability is capped in some way. We don't want this to be something that people are losing their sleep over. It's got to be something that seriously makes them think twice about hiding anything or lying about anything, or misrepresenting anything. But it's not going to be something that some of the founders say, no, I don't dare that because I don't know whether tomorrow I'll have to leave my house.
Okay, we have one exception when it comes to that, because we normally accept that there is a cap, but not when it comes to taxes. You have to have paid your taxes, however big they are.
Yeah.
And probably not with respect to outright lying.
So willful conduct,
Yeah.
willful misconduct, right? But then we would sue, right? Which would fall outside this for loss, right? But other than that, we could cap it at the invested amount, right?
At the invested amount. But that's that's too high. That's going to bankrupt anything.
Yeah. I have to sell my car.
Well, let's see your car first.
And obviously, but I sense that it's standard representation on warranties, so it's
We'll give you a copy.
Okay, I think this is. But what is normally also a discussion is whether it's going to be to the best of your knowledge or not, or if it's just.
But obviously, it's to the best of our knowledge because we cannot indemnify you for anything that we. I mean, we're not an insurance company.
You could indemnify us for things you should have known.
Yeah, but that would be covered by the best of our knowledge.
Okay.
Would it?
Okay, now we're getting into that's pretty technical lawyer stuff, and people spend a lot of time arguing about it, but we're not going to do that right now. We're going to go on to the next one, which is
Just give a little bit.
okay.
Well, right, so what you want to do here is you want to cap it at the invested amount, and then you want the VC to come after you and take your shares before they take your money, and potentially be capped at the shares, right?
Yeah.
So that we can only come and take away your shares, but not your house or your car or whatever, right? And most VCs would agree to that, right? Except if it's like really fraud, like fraud. So cap the amount and move it into the shares, and
If you're defrauding anybody, you're a deep shit all the way around.
yeah. Don't defraud anyone, right? But other than that, keep it to the shares.
Okay, thank you. So next up, we're going to talk about anti-dilution. Before we get into it, raise your hand if you know what a full ratchet is. Here we got one.
Not even Martin.
Never heard about it.
Okay. What and it's different. I should say anti-dilution is a little different in the U.S. versus Europe. But the idea here is that if there is a future financing at a valuation that's less than the current financing, then is it appropriate for the VCs to get an adjustment downward in the price? And if so, how does it work? Do you look at the full, like if you think about a glass of water, if you drop a little bit of ink into the water, then you're going to see that color in the water, but everybody is diluted in a sort of a pro rata way. If on the other hand, you drop something into the water and now the price has gone from say $1 a share down to 50 cents a share, do the investors then get the full benefit of the cut from $1 to 50 cents? In which case, all of the dilution gets is incurred at the cost of the existing shareholders, the founders. So anti-dilution, it's a mathematical formula, and I can say that in the documents it can take pages of language, but that's what we're going to talk about. So I'll cut to you guys.
We can accept some anti-dilution policy. A full ratchet anti-dilution is, I think it's unheard of here in Scandinavia. I've never seen it. I've never heard an entrepreneur accept it.
That's why I never heard about it.
Yeah. So, and I cannot really see how you can hire a lawyer that would put it in there. Maybe that's how he think he's going to make his salary. But we would like to offer a broad-based weighted average anti-dilution.
Anti-dilution is fair because we are betting that the company has a certain value, and we are betting that we are able to set the market value for the company. If for some reason it shows that the company doesn't have this market value, it has a different market value, a substantially lower market value. Okay, we have bought into something that you have sold us to a too high price. Is it fair that we get compensated for the difference? I would say yes. I mean, you have sold what you have at a too high price. I want the fair price, and the fair price is the market price, and to compensate us, we need a full ratchet anti-dilution. That was a good one.
It's a question. It's a question of asymmetrical information, right? You have so much information around this business. We can only spend so much time on it. We can only spend so much time on the industry. You know much better than us what this is really worth, right? But we'll take your word for it and give you the valuation you asked for, right? But then give you this provision.
Yeah.
But then first of all, if that's the case, then this clause should only apply for a certain period, because or you should refrain from sitting on the board, because you obviously will know as much with all these different clauses regulating your board activities. You will know as much about the company going forward. So we could probably have this. We can have a discussion and saying, yeah, you can have full ratchet for 6 months or something like that, and then no anti-dilution after that. But I don't think you would agree to that.
Well, we need the anti-dilution to last until another fundraising event has occurred, right? Because otherwise, what's the point? There won't be another market value.
So then let's not go with full ratchet then.
Yeah.
And I think we've seen the valuation of the company rise as our success has grown. And if we make a down round, that must be because the valuation went down since you came aboard. And I don't see how we should be looking at that.
But you guys are running the company, and if a board member who is there once every month knows as much about the company as the management team who does it all day, every day, I think it's a poor management team.
But the point is that even if we wanted to, which we of course want to maximize and do whatever it takes to maximize the value of the company, the influence you have on the board makes us extremely limited in doing whatever we want to do. So you have a very direct influence on what direction the company is going. And if you are telling us that we have to suffer for all your decisions on the board by having anti-dilution going forward, then it doesn't really make sense. On the other hand, we know that this is maybe there is some kind of anti-dilution going forward, market value, even though that it's totally unfair on these grounds that I just mentioned. So we're probably going to accept something. But we have another suggestion, and the problem is with anti-dilution from my point of view is, first of all, that we don't think that we are going to get much problem with anti-dilution as founders. The rest of the investors are going to do, because if you're diluting us too much going forward in a situation, you're totally taking away our incentive to actually to run the company. So you're probably going to compensate us. But the rest of the investors are going to get screwed. And that's a problem. You could say that's not a problem for us, but it's a problem for those investors that are going to be part of the decision for you to come in and invest. So they're probably going to say no way this is going to happen. We have to find some kind of way going forward that they will accept it. And we think that the other part is that if anti-dilution takes place, is triggered, then it should only be an economic thing. It should only entitle you to get more value out of the company if there's an exit. You shouldn't get the equivalent voting power. So we are suggesting what we see in some American similar contracts, that this is something that only is triggered by an exit. At exit, then you are getting the shares that you would be receiving under the anti-dilution protection.
So what you are suggesting is that we are compensated by shares with no voting rights.
Yeah.
Okay.
Or you don't get any shares, you just get them when there's an exit, and then you get your money.
That's a technicality, but.
And then you're saying there has to be some kind of timeline on it, right? So we get to a fundraising event, and then you want a weighted average.
Yeah, at least a weighted average.
Yeah.
But the timeline, well, we feel that anyway when you go
we
to
got agreement on that, right? That's good.
That's the solution.
Okay. The one thing I'll say about anti-dilution before I did a little research into what's standard in the USA for what it's worth. You might say, well, this full ratchet. I mean, it just sounds bad. I mean, does anyone actually ever use a full ratchet? And the answer is, according to research in the most recent quarter in the Silicon Valley, 3% of the deals had it, which is kind of surprising, right? In my view, it just means that there's a complete disconnect between the VCs and the founders regarding valuation. And the VCs can just say, okay, fine, we're not going to fight you on the valuation, but we're going to put in a full ratchet. Yeah, good question.
How many of those 3% had a lawyer representing them?
Oh,
They all
I guarantee you.
Yeah.
These are reported venture findings.
But it comes back to another point, which is that sometimes as a company, you can ask for so high a valuation that the VC will agree to it, but kind of pollute the pond in other ways, right? So we'll ask for multiple X liquidation preferences, full ratchet and all that stuff, and it's not good for the company. So you should not push the valuation beyond what it can bear. And if you find that the VC start putting these things in, then your valuation is too high.
Yep. And the other thing, and we're going to take the broad-based weighted average, 96%, and only 1% of deals had no anti-dilution. Yeah. Go ahead. Do you want to say something, Lars?
Just maybe one comment combined with a question. Now that you are talking about evaluation, I think you guys were not maybe really warmed up in the first round. The actually pricing of the company went into some kind of discussion about option pool and stuff like that. And you kind of left what I think is a really important topic here maybe, that because you had the two tranches, and for me it comes down to what is the VCs actually willing to accept here as a total ownership for both tranches. And you kind of skated over that.
And we touched on it a little bit, right? And what I was trying to do was to set up a basket. So it's basically from our perspective, it doesn't really matter what we pay for the first tranche. Because if the company's successful, we'll put in the second tranche, and it's what we get at the end of that really matters, right? These guys will try to cut me in different ways. So I will try to produce this basket and say, let's agree on it later, put it in the basket, and then when we have the first tranche valuation, second tranche valuation, the option size, and all that stuff done, then I can look at it as one deal, right? As a founder, if you're the one coming back on our term sheet, you want to try to lock me in on all the different steps. Does that make sense? And I want to keep all the steps fluent so I can juggle many balls at the same time.
Which means
one big deal.
Which means you are happy to end up with what ownership?
So that depends on the deal, right? But as Ravenous Ventures, I think this is a bare minimum, right?
But I would like to say, in general, I often see entrepreneurs putting too much emphasis on the pre-money valuation and losing out on all the other terms. The pre-money valuation is okay. It might be a victory when you get the VC to accept a high pre-money valuation, even with all these other things. But remember, there's going to be a next round. And the VC will sit there and say, next round, we want 3x on the last one. And you might get a new VC coming in with even rougher terms to be able to accept that 3x, and you might really have hurt yourself on in the long term.
Another way to put that might be to say, well, you shouldn't care if you get if the company is very little worth when you get the initial investment, if you got a bigger part of it for the later stage.
Yeah, excellent. So.
Yeah. Okay, we're going to take a break and come back, and what do you think? 10 minutes? Does that sound good?